So it's Thursday, January 22nd, 2026. And I want to start today with a specific number, $88.
Give or take.
Yeah, give or take a buck. And that's where the spot price of uranium is sitting right now. And if you're just, casually glancing at the energy markets, that number probably looks boring.
It looks like stability.
It looks like a market that's asleep.
Right, but that's the whole problem.
Right.
Because if you look at the headlines, asleep is the last word you'd use.
Not at all.
We're supposedly in the middle of a nuclear renaissance. You've got tech giants signing deals for data centers, governments locking in net zero targets that basically require nuclear.
It's the strongest demand story for nuclear in, maybe 50 years? The fundamentals are just incredibly loud right now.
So here's the disconnect. If the demand is screaming, why is the price whispering? Generalist investors are looking at $88 and thinking, okay, if there's a deficit, why isn't this chart just going vertical? And that is the paradox of early 2026. But the mistake, I think, is assuming the spot price tells you the whole story. It's like looking at the weather outside your window to understand global climate.
Right.
What we found in the research for this deep dive is that there is a massive dislocation happening.
Right.
But it's all happening under the surface.
And this is what we're calling the ghost demand.
Exactly.
Yeah.
There is a demand swing happening right now. We're talking roughly 40 million pounds of uranium a year that just does not show up on any standard reactor count chart.
You can't see it by counting power plants.
It's invisible to the casual observer, but it is actively, right now, draining global supply.
40 million pounds. Just to put that in perspective, that is not a rounding error. That's a huge chunk of the market.
Massive.
But to understand where it comes from, we have to stop looking at the mines and the reactors. We have to look at the messy middle.
In the midstream. We have to look at enrichment. This is the part of the fuel cycle everyone's eyes glaze over, because the math gets a little heavy. But today, we have to talk about a phenomenon called overfeeding.
Okay, overfeeding. I'll be honest, when I first saw that term, I assumed it meant we had too much supply. Like we were overfeeding the market.
It's funny, right? But it's the exact opposite.
It's the opposite.
And I know the technical documents from the EIA can get really into the weeds here, but we can strip this down.
Well, one of the sources we looked at uses an analogy about orange juice. Now, I'm usually skeptical of these things, but does this one actually work?
It actually holds up surprisingly well for the economics. So yeah, let's run with it. To get nuclear fuel, the actual fuel rod, you need two things. You need oranges, which is the natural uranium.
The stuff you dig out of the ground.
Right. And you need a juicer.
And the juicer is the enrichment centrifuge.
You got it. But here's where we need the real term, because you'll see it everywhere. The capacity of that juicer, the effort it takes, is measured in SWU, separative work units.
SWU. Okay, so SWU is basically the horsepower of the juicer.
Think of it as the effort. How hard do you want to work to squeeze that orange? And this is where the economics get really interesting. The relationship between the oranges, so the uranium, and the juicer, the SWU. It's flexible.
How so? I mean, usually if I want a glass of juice, I need a set number of oranges.
Not an enrichment. Let's look at the era we just left, from about 2011 to 2022. For that whole decade, the world was awash in enrichment capacity. We had way too much SWU.
Too many juicers.
Way too many. And since SWU was cheap, companies ran their machines on what you'd call slow and super efficient mode.
So in the analogy, they were spending 10 minutes squeezing every single drop of juice out of one orange.
Exactly. They were grinding the rind. In technical terms, they were running a very low tails assay, around 0.15%. And because they were squeezing so hard, they needed fewer oranges to fill the glass.
And this is what they call underfeeding.
Yes. And here's the kicker. Because they needed less uranium than they'd already contracted for, they ended up with leftover oranges. They'd buy the uranium, get the fuel they needed, and then sell the excess back into the market.
That's wild. So the enrichment plants were acting like a synthetic mine.
We call it the ghost mine. For 10 years, this process added about 20 million pounds of supply to the market. Every single year. It kept prices low.
Okay, so that sets the stage. A decade of efficiency, excess supply, but we're recording this in January 2026. That era is over.
It's not just over. It has been completely inverted. And the catalyst is geopolitical. We have to talk about Russia and Rosatom.
This goes back to the Prohibiting Russian Uranium Imports Act that the U.S. signed in 2024.
That's the legislation. But the physical reality is about capacity. Rosatom controls about 40% of the world's enrichment. That's 40% of global SWU.
40% of the juicers.
Right. So when the West decoupled from Russia, we didn't just lose a trade partner. We walled off almost half the world's juicers.
But all the reactors in the West, they still need their fuel.
They do. So now, the Western enrichers companies like Urenco and Orano are absolutely slammed. Their order books are full. They're running at 100% capacity. They can't spend 10 minutes on one orange anymore.
They just need to move volume.
They have to switch to fast and messy mode. To get the fuel out the door, they give the orange a quick squeeze, get the easy juice, and toss the rest.
So, to get that same glass of juice, they now need way more oranges.
Significantly more. And this is overfeeding. The math here is actually startling. When you go from that efficient 0.15% tails assay to this fast mode of, say, 0.30%, you increase your need for natural uranium by about 31%.
Wait, say that again? 31%.
Roughly 31%.
So let me just pause on that.
Yeah.
Even if we don't build a single new reactor, just by changing the settings on the centrifuges we already have, we suddenly need 30% more rock from the ground.
That is the aha moment. Yes. And this brings us right back to that 40 million pound ghost demand. It's a double whammy.
Okay, break down the 40 million for me.
So first, you lose the 20 million pounds of supply from the ghost mine. That underfeeding supply is gone.
Okay, that's minus 20.
It's gone forever.
Yeah.
Then, because of this fast and messy overfeeding, you create about 20 million pounds of new demand for fresh uranium.
Ah, to make up for the inefficiency. So minus 20 flips to plus 20. That's your 40 million pound swing.
It is huge. I mean, for comparison, the world's largest high-grade uranium mine is McArthur River in Canada. It produces maybe 18 million pounds a year.
So this invisible shift in enrichment is the same as two of the world's biggest mines just vanishing, while a third new mine's worth of demand appears out of thin air.
That is the scale of the problem. And remember, you can't just flip a switch on a mine. They take 10, 15 years to build.
So if the math is this stark, why isn't it priced in? Why the reporting gap?
Well, enrichment contracts are proprietary. Urenco doesn't tweet out their daily tails assay settings. It's a black box. But more importantly, there's a lag. There's a 12 to 18-month delay between the decision to overfeed and that demand actually hitting the physical market.
And we are in that lag period right now.
We're in the impact zone.
Yeah.
The decisions were made in late 2024 through 2025. Now, in early 2026, that physical demand is crashing into the market.
So we have the mechanism, overfeeding. But I want to talk about the buyers, the utilities. You mentioned a contracting cliff. If I'm running a reactor in the Midwest, how much trouble am I in?
Well, if you haven't bought your fuel for the coming years, you are in significant trouble. The data from the World Nuclear Association on uncovered requirements is pretty clear.
What does that curve look like for this year, 2026?
For 2026, it's manageable. Maybe 15% uncovered. Most are covered for this year. But 2027, that is where you see the cliff edge.
How bad is it?
The uncovered number just jumps to roughly 35%. That's about 60 to 70 million pounds of uranium that needs to be delivered next year. But nobody signed a contract for it yet.
Why would they wait? Is that just bad planning?
It's risk aversion, maybe complacency. For a decade, fuel was cheap. It was easy to get. Utilities got used to just-in-time thinking. But in nuclear, just-in-time is dead.
Because the whole fuel cycle takes, what, 2 years? Minimum.
Minimum. So if you need fuel for 2027 and you haven't bought it by now,
You're already late. You're panic buying.
that's the lead lag cycle. 2026 is the panic point for 2027 and 2028 deliveries, and the U.S. is uniquely vulnerable here.
Because we have the most reactors.
The largest fleet in the world, about 93 of them, and we produce almost no uranium. We're totally dependent on imports. The EIA says by 2028, U.S. utilities have an 11 million pound shortfall. By 2030, it's over 20 million pounds a year.
And they are trying to fill that gap at the exact same time this ghost demand is eating the global supply.
Precisely. And the cupboard is getting bare. We can't forget the financial players here, like the Sprott Physical Uranium Trust, SPUT.
Right, they've taken a huge amount of material off the market.
Over 100 million pounds between them and strategic reserves.
Yeah.
And that material is effectively locked up. It's in a vault. SPUT isn't going to release that just to help a utility out of a jam. It's deleted from the tradable supply.
Okay, so let's circle back to the start. We've laid out the shortage, the mechanism, the panic. But the spot price is still sitting there at $88. Where's the evidence? If the house is on fire, where's the smoke?
The smoke is there. You just have to know where to look. You can't look at the spot market. It's too thin, low volume. The real market is the term market, the long-term contracts.
So the spot price is like the price of a t-shirt at a garage sale.
In a way, yeah.
Yeah?
But the tells are visible if you look at how the big players are behaving.
Okay, so let's go through the tells. What's the biggest red flag?
Signal number one is Cameco. They're the second largest producer in the world, a mining giant. But if you look at their recent activity, they're buying.
Wait, hold on. A miner is buying uranium. That seems completely backwards.
It's the ultimate signal of tightness. Cameco is overcontracted. They promise to deliver more uranium to their customers than they can physically pull out of the ground right now.
So to honor those contracts, they have to go into the spot market and buy material themselves.
Exactly. When the guy who owns the shovel is buying dirt from someone else, you know there isn't enough dirt.
That's a huge signal. What's number two?
Signal number two is Kazatomprom, the world's largest producer out of Kazakhstan. They supply something like 40% of the world's uranium.
And they've been having problems too.
Significant problems. They officially cut their 2026 production guidance by 10%. They wanted to produce about 85 million pounds. Now they're targeting maybe 77.
And that's because of the sulfuric acid shortage.
Right. Their mining method needs huge amounts of it, and they just can't get enough. So at the exact moment the West needs 40 million more pounds, the world's biggest supplier says, sorry, we're producing less.
It feels like every single lever that could go wrong is going wrong all at once.
It's a convergence of bottlenecks. And speaking of bottlenecks, that brings us to the narrowest pipe in the whole industry. Conversion.
This is the step before enrichment, turning the yellow cake into UF6 gas.
Yes. And there are only a handful of facilities in the West that can do this. And if you look at the price for conversion services, they are at record highs.
Which confirms what, exactly?
It confirms the system is clogged. If you're overfeeding the centrifuges, you have to push more volume through conversion first. The high-price conversion is the smoking gun that proves overfeeding is physically happening right now. The pipe is bursting.
And this leads to something we saw in the research called the Western Premium. This basically breaks the idea that uranium is just one global commodity, doesn't it?
It does. Uranium isn't fungible anymore. You have a split market. Western origin material from Canada, Australia, the U.S. is trading at a premium.
Just because of that conversion bottleneck.
Right. The Western conversion plants might not accept material from certain places, or they might just be full. So utilities are fighting over specific flavors of uranium that can actually get into the fuel cycle. It's not just about getting uranium. It's about getting the right uranium.
So we've got a split world, a split market, and a massive deficit. But before we wrap up, I want to throw one more variable in here. We've been talking about standard reactors. What about the next generation? SMRs, small modular reactors.
Ah, yeah, that's the multiplier. SMRs are the darling of the tech world, but most of them need a special fuel called HAU high-assay low-enriched uranium.
And how is HAU different from what we've been talking about?
Standard fuel is enriched to maybe 5%. HAU is enriched to nearly 20%. If you think standard overfeeding is draining supply, HAU is a beast. To produce 1 kilogram of HAU, you need about 5.5 times more SW.
5.5 times the effort from the juicer.
And significantly more uranium feed. So every time a tech company announces a big new SMR fleet for the 2030s, they're piling massive future pressure onto an enrichment system that is already breaking today.
It really seems like the market is trying to solve a 2035 problem while completely ignoring the 2026 crisis.
We're trying to build the roof of the house while the foundation is cracking.
So bringing this all together, we've gone from a flat spot price to this 40 million pound invisible hole in the market. What's the final takeaway here? What's the thing you want people to be thinking about?
I think the market is asking the wrong question. Everyone is asking, can we build enough mines to feed the reactors? That's the long-term question.
Right.
But the immediate question, the one for 2026, is much, much scarier.
Which is?
What happens when the miners themselves have to buy from the open market just to survive? We're seeing it with Cameco. If Kazatomprom misses its targets again, they might have to do it too.
It becomes a circular firing squad.
Exactly. When the producers become the desperate buyers, who is left to sell? Are we looking at a price squeeze? Or are we looking at a total breakdown of the fuel supply chain where physical delivery just fails?
That is a sobering thought. It turns out the spot price isn't a measure of stability at all. It's just the calm before the inventory squeeze.
Always watch the midstream. The mines matter, but the real bottleneck is in the centrifuge.
We'll leave it there. A complex web of juicers, oranges, and geopolitics. Thanks for walking us through it all.
My pleasure.
And thank you for listening to The Deep Dive. We'll see you next time.